Hi, everybody. Thanks for joining me. Today, we're going to talk about how to manage your RSUs. And I've got some slides here that I'm going to go through, and then I've got a spreadsheet I'm going to show you if you have some historical RSUs. That's the topic of the day. As I'm talking, please feel free to put your questions in the chat or in the Q&A, and I'll get to them at the end of the presentation. I'd like to get through this in 20 minutes. It's a lot of stuff, so I'm not sure I will, but I shall do my best. So here we go. Let me just maximize this. And hopefully you are, oh, I think I was sharing the wrong screen. Boy, all kinds of problems today. Number 2, share. All right, there we go. Hopefully you're seeing the right screen with all the slides. If you are not, please put something in the chat and let me know. You should see a big title slide that says how to manage your RSUs, May 6, 2021. That's what we're talking about today. So why am I talking about this? If you've attended these before, you know I work with clients that take away their money worries. This is not financial advice. Financial advice is specific to you and your situation, and I can only give it financial advice to my clients. Thank you for telling me it's all good. What we're talking about here are possible moves, money moves, what I like to call money moves, that might be good for you or might not. I don't really know. And so treat this as an educational opportunity, not as financial advice, please. I've done a bunch of these webinars on different topics. You see them there at the bottom. If you want to see replays of those, just reach out to me and let me know. You'll be getting an email, so we'll be in touch after this. So first off, I want to talk about how RSUs fit into your entire financial life. So if our goal is to create clarity in our finances and build towards our own personal best financial life, there's 4 areas we have to cover: protecting what you have, knowing where it goes, that's spending; making it grow, that's investments; retaining independence and dignity, that's the long-term planning. And we got to do all of that with intentional and purposeful effort. And so what we're talking about today is this area right here, making it grow on the investment side, where this fits into my process. And I only show this because I want you to see the relative importance. Is it's way down here, right? It's not the first thing we do. You have to know where you really want to go first before you can really make those best decisions for you. And then we have to know where we are in terms of our spending and our wealth. And only then can we talk about where we want to go. So it's a little bit further down the line. So today's agenda, we're going to define what is an RSU. We're going to talk about why we should have a process to sell. And then I'm going to provide a tax smart way to transition your existing RSUs out into the rest of your financial life. So what is an RSU? An RSU stands for restricted stock unit. It simply represents a share of stock in your company if your company is public. So I'm only talking about public companies today. If your company is public, an RSU represents a share of stock. It's awarded to you at a certain date in shares. So when you get your stock award, you're probably told you've received $40,000 in stock. That's not exactly true. You've received a number of shares of stock that today equate to $40,000. You don't actually get it today because these are going to vest at certain dates in the future, and the value is going to be dependent on the stock in the future. So you get shares, they vest over a certain time. When they vest, they are taxed as if they're income. We're going to talk a little bit more about that. And after vesting, you're free to sell or hold or do whatever you want with the shares. You can transfer them to another account, whatever you want to do. Typically, your unvested shares are going to be lost when you leave employment, which only makes sense. You'd have to be there for them to be vested. That's not always the case, but typically that's the way it works. So first question, or the next question is, when should I sell? Well, obviously when the stock is high. If we know where the stock's going to go in the future, then we know when to sell. And that really is the best time. But of course, no one knows this. Even though we may feel like we have strong opinions about our company stock and what's going to happen in the future, we don't know that it's going to be higher. So we have to really sort of accept that. So if we don't know what the stock is going to do in the future, then what do we do? Well, here's what most people do and how they think about their company stock if they don't have a plan. There's two scenarios. If the stock is falling, then their feeling is, I don't want to sell. I want to wait until it gets back up where it was. So I'm not going to sell if it's falling. If it's rising, I don't want to sell because I want it to keep going up and I see my balance going up. And we can easily see if we're not going to sell when it's falling, it's not going to sell when it's rising, and it's always doing one or the other. Our strategy, even though we're not on purpose having this strategy, our strategy ends up being never sell. And the stock builds up, builds up, builds up. And you might be feeling that, hopefully a few of you are nodding your heads there, you might be feeling that in your own personal life. That's not a great strategy from a risk reward perspective. Now, if your company turns out to be Facebook or Tesla or Amazon or Google or whatever, it could be a fantastic strategy, right? The way to get rich is by being very undiversified and being right. The challenge is we never know when we're right or when we will be right. So what I'm talking about here is balancing the risk with the reward. So again, when should we sell? Well, a couple questions. First off, when will you use these funds? When will you actually spend this money? If you're going to spend it within the next 5 years, consider selling it now. We don't want anything at risk that we're planning on spending in the next 5 years. What does the rest of the portfolio look like? If you have the bulk of your exposure in stock, then I would suggest it's probably a good idea to pare it back. And even if neither of those are true, I would still consider selling the stock today. And here's why. You have your income coming from your employer, and now you have a part of your wealth coming from your employer. So you are definitely undiversified from that perspective. And the question is not so much, how much money can I make by leveraging up and having all of this exposure to my employer? The question is, how does it affect you in the downside scenario? Because we know downside scenarios happen, and we have to be able to survive them, to ride through them. All right, so a way to think about how much company stock that you have, and I went through these slides last month when we talked about ESPP, so I'm going to go through them fairly quickly here. But here's somebody who has 20% of their total assets in company stock. They've got 10% in savings, 30% in 401k, 40% in their house. Well, their house, they can't really spend on things, right? So if we take the house out, now we see in terms of their financial assets, they've got 33% in stock, and you see what they have in the others. Well, half of that is in their 401k. If they're under 59 and a half, they're not going to spend their 401k. So now we got to take that out and we say, okay, of our liquid assets, of the stuff that is going to affect us today, we all of a sudden have 67% of our liquid assets in our company stock. So very undiversified in that scenario. So I would consider going through that exercise and thinking about how much company stock represents of your liquid assets. Now, let's talk about taxes. Taxes are obviously important. We never want taxes to make the decision for us, but we always want to consider the tax situation when we're making decisions. So here's the way RSUs are taxed. It's fairly simple. When they vest, you're taxed. That's it. When they vest, you're taxed as if they're income. And so it's like you received a paycheck in that dollar amount. But that paycheck, instead of getting it in cash, you got it in stock. Now, I'm sure you've noticed that some of the shares are automatically sold and that money's sent off to the IRS as withholding. That's the same thing as your paycheck, where some of the money goes off to the IRS for withholding when you get a paycheck. Now, when is the last time you received a paycheck and turned around and put it all in your company stock? I'm going to guess you never did that. But every time you let RSUs vest and you don't sell them, that's exactly what you're doing from a tax and a risk perspective. So as a general rule, I don't think that's a good idea. Depends on your situation and what it is you're trying to do. But for the most part, I like to sell RSUs as they vest. So that's what happens in terms of taxing RSUs. Anything beyond that, tax effects after you've held the stock, is the same as holding any other stock. So let's kind of move forward and talk about that for a second. Older RSU positions. So you've had stock, you've been receiving stock for a number of years. you've let the inertia take on, or whatever the case may be, and you've had the stock build up. What's the situation there? Well, what should you do? Well, from a tax perspective, it depends. And what we need to do is we need to make a plan for shifting that stock into the rest of our financial life. Again, assuming it's a significant portion of your overall financial risk, overall liquid assets. And then in that case, I think this is something you need to do, because you want to use these funds, you want them to grow and use them in your later life. You don't want to take that risk today. So if that's the case, we want to make a plan. And we need to consider, obviously, your need for cash today, your concentration in the stock, the diversification of the rest of your portfolio, and the tax situation of each vested lot. Now, what the heck do I mean by that? Well, here's what I mean. When that stock vests and you don't sell, on the date of vesting, it's as if you bought the stock on that day at that price. From that day forward, you have capital gains or capital losses happening. Let's just assume the stock goes up. The stock goes up, you have capital gains. If you wait 3 months and sell it, you have short-term capital gains, which are taxed higher than long-term capital gains. If you wait 9 months or 11 months, you still have short-term. You have to wait 12 months, or actually longer than 12 months, 1 day longer, to get long-term capital gains tax treatment. The difference is about 15%. In other words, the tax rate is going to be about 15% lower to wait that full year. Now, I'm not saying when it vests, you should wait a full year, remember? And when it vests, you want to sell it immediately, because you're taxed and the clock is just started on that long-term gains, and you have no gain or loss, right? You're exactly even. But if you have held it already and you're 3 months in, and let's say you've got a gain of, I don't know, $5,000, that's going to be taxed at short-term capital gains. And so now you have to ask the question, does it make sense to wait another 9 months to get long-term capital gains treatment? Or is it possible that my stock will fall in that 9 months and I'll lose the gain at all? Maybe it's better to go ahead and pay that higher tax rate and put the money in my pocket. I don't know. But that's what we want to consider. I want to go, we've got 5 minutes left in the prepared presentation. I am going to stay on as long as it takes to answer questions beyond that, though. So don't worry, I will get to the questions. I see some of them coming in. So we've got all these old RSUs. How do we sort of sort through all of that? Well, here's where one of my favorite things in the world comes into play. Guess what that is? It's a spreadsheet. All right. So this is well, I don't know if it's fancy, but it's kind of a fancy spreadsheet. Everybody's attending this webinar will get a link tomorrow to download this spreadsheet, as well as the slides and access to the replay. So that's all coming to you. So don't feel like you have to scribble this all down. I just want to go through it very briefly. So here's what we have. We have this person's RSUs. Here are the grant years that they got, summary. This stuff is kind of important in terms of a summary, but really what's important is we want to look into each individual grant. So here's the 2016 grant. Here's each vesting. You can see here's the price on the date this stock vested March of 2017. The stock was worth $80 at that point. What happened was this person was taxed on $80 worth of stock on March 15, 2017, and $80 became their cost basis to calculate any capital gain or loss going forward. And we can see that we've got a unrealized gain, a capital gain of $17,000. It's certainly long-term. And so here's the tax cost of selling it. So the market value of this lot is $25,000, $17,000 gain. We're going to pay taxes at, we have to assume a tax rate, right? So here's our short-term tax rate. Here's our long-term tax rate. We're going to, and oh, I just realized this is wrong because one of these has state and the other doesn't. We got to do that. There we go, spreadsheet updates. So 50% versus 35%, that's that 15%. I said it's different, just an estimate. All right, back to this. Here we go. Long-term, it's going to be taxed at the 35%. The tax cost then is 35% of 17 because just the gain, the other 8,000 we were already taxed on way back here on this date. And so our tax cost is going to be about $6,000 on the 25,000. So I'm calculating this ratio called tax cost over market value. That's all it is, just this divided by this to say how much of this money is mine And how much of it goes to the IRS and the franchise board in California? This is for a person in California, 24%. Now look at this lot, 18%, and here's 10%. Now let's go to the 2017 awards. We've got some that are 9%. Here's 9%. Which ones of these do you want to sell first? Well, I would sell the ones with the lower tax cost. So if I'm selling these over multiple years, multiple tax years, let's say I've got so much built up, I don't want to take the tax hit all in one year. I want to get as much exposure out as I can with the least amount of tax cost. So I'm going to sell my 9s, right? And maybe my 10s. I don't know. The way I would do this is I would total up the total tax cost here, $56,000 my tax cost, and say, I want to sell this over 3 years. So this divided by 3, I'm going to take about $18,000 in tax cost each year. But I'm going to do it in order of the lowest tax cost per market value. And when you do that and you add these tax costs up and you get up to $18,000, you're going to sell a lot more than 1/3 of the stock because you're selling the lowest tax cost. Hopefully I'm not making a mess of explaining this, but the idea is to front weight your sales, but have a lower tax cost at the time. So that is the spreadsheet. We'll share it with you. You'll have to plug in your own information, of course. Now, so that's all great in general information. What about you? So here's what I say about you. Download these slides. Think about this situation as it applies to you. If it applies, and if you have large RSU positions and you feel like you need to sell over multiple tax years, download the spreadsheet, take a look at it, fill in your information, think about it, and schedule a call with me. I'm happy to discuss this with you, how to do it. Again, like I said early on, one free coaching session to everyone. All you have to do is email me, joe@bestfinlife.com. Again, no cost, no sales pitch. And that's the deal. Now, let me step back a second and talk about planning for just a second. If you think about the rest of your financial life, where you're headed, what the goal of any planning should be to allow you to do everything you want in life and die with at least $1 in the bank account, right? You want at least some money in your bank account when you pass away. Call that door number 1. Door number 2 is we miss out on doing things that we feel like we could have or should have done. At the end of your life, those are the only 2 outcomes. The only 2 possible outcomes are door number 1, where you get to do everything, and door number 2, where you don't. Whether you get to do everything you want depends on a lot of things. A lot of things are going to happen between now and the end of your life. Your opinions are going to change. The market's going to change. You might get married, have kids, who knows? A lot of things are going to change. And it's not guaranteed you're going to get to do everything you want in life, of course. But without the process of planning, I think it's a much greater chance that you end up at door number 2, where you don't get to do the things you want. So that's just sort of my little speech about planning. I think it's super, super important, clearly. Some more resources. I do have a podcast, Deliberate Money Moves. It's out there everywhere, Spotify and Apple. Check it out. And my blog at my website, bestfinlife.com, and my email address, joe@bestfinlife.com. And the way to remember that is it's BSTFINLIFE, because bestfinanciallife.com was way too expensive and I wasn't willing to pay for it. That's it for today. Our next webinar will be June 3rd, and I'll talk about building a long-term portfolio, and that will answer the question, okay, I sell all these RSUs, what do I do with the cash? That's what we're going to talk about next month, building a long-term portfolio. Thanks so much for attending. I really appreciate it. And I am going to go look at the questions and start answering them. So if you have questions or thoughts that came up during this, please type away and let me know. Okay. All right, here's a question. It seems that you need to know that you would want to invest your RSUs. Okay, it seems that you need to know what you would want to invest your RSUs in to make it grow and be more diversified. And that is one of my big challenges. Absolutely. Next webinar, you said it right there. I hear that a lot. You know, my industry makes this whole investing thing super confusing. I try to make it simple. I've been doing this for 30 years for large institutions and families. And let me tell you, it doesn't have to be complicated. So we could do that. All right, next question. Joe, if we sell stock one day after it vests, that is 1 day of short-term gain between what the price was at vesting and the next day, correct. So if it vests today at $250 a share and you sell it tomorrow and it jumps to like $400 a share, you've got $150 of short-term gain. That's a big short-term gain. Now, the question facing you is, do I hold it for another 364 days to get 15% lower tax rate? Or is it possible that the stock could drop 15% or more between now and then? And if you think option number 2 is right, then you might want to go ahead and sell and pay the higher tax. Remember, the objective is not to minimize the tax we pay. The objective is to maximize the amount of money that comes into our pockets. So we got to look at the whole situation. Yes, that is correct. That's how it works. Should I consider my future unvested stock grants as part of my long-term portfolio too? That's always a good question. Love it. You should always know what they are. You certainly have exposure there, assuming you're staying at the firm and you're planning on, actually having those vest. So you have exposure there, but there's nothing you can really do about it. So I don't really like including that in that percentage calculation for that reason. So you could have, by my calculation, you have 0% in company stock, but you still have exposure, not only through the fact that your income comes from there, but you have all this unvested stock that you're still riding until the vest date. So don't think that going to 0% vested means you have 0% exposure to the stock. You have all this unvested stock. Very good point. Thank you. Do you give tax advice or do you refer your clients to a CPA? I do not prepare taxes, but so much of financial planning has to do with taxes. Of course, I have to know a lot about taxes, and I'm a CFP, so that's kind of where that comes from. So definitely include taxes in pretty much everything we talk about. But when things get a little bit too complex, like for example, when clients have ISOs, incentive stock options, and that affects AMT, and to do the AMT calculation, you basically have to do a mock tax return. We got to go to a CPA, your CPA, to help with that. So anything super complex, I'm not going to step in there. I'm happy to help that conversation and facilitate the conversation, assuming you're a client. But we're not going to, I'm not going to step out of my realm of expertise there. But certainly have to look at taxes and everything. Here's a question. Let's see. I do have one more question. I've got 2 more questions here, and they're both kind of sales oriented. So I'm happy to answer those. I just want to give folks a time to ask any other questions that they might have, because again, I always promise no sales pitch, which means no sales pitch. So I don't want to. I'm happy to answer these questions. I guess I could come back to you directly as well, but I just want to give folks time to ask any other questions. Oh, I see. I got to scroll. I'm not scrolling. Okay. Do you have any specific advice for people subject to lockup periods where they can't sell? More aggressive, sell when vest? Great question. We work around lockup periods in this. So if you're talking about it, like we just went IPO and we have a lockup period, it's kind of like unvested stock. There's not a lot we can do there, right? But we do have all this exposure. We have to look at it on or around the vest date to see the tax effect. And again, at that point, you're going to have some capital gain. And does it make sense to wait until the year is up? Now, it may be less than a full year at that point, because it's not from when the lockup expires, it's from when the vest expires or when the IPO happens. But we have to look at those details there to make sure. More aggressive, sell when vest. And that's part of that same question. So again, let's go back to the overall objective here. The overall objective is to reduce our exposure to company stock. And so if we've got, let's say we've got a bunch of RSUs that have built up, but the tax cost isn't really that high, or we don't mind paying the tax cost this year. If that's the case, go ahead and blow them out. Pay the tax cost, Get that money into your long-term portfolio and have it working for you on a diversified basis so you don't have the risk of such a large drop for your personal wealth. So, I'm always in favor for reducing stock. I'm not sure I would say aggressive sell invest. I appreciate the phrasing, but I do think it's more about being aggressive in reducing the risk. This is a risk conversation more so than anything else. Okay, how much of your net worth as a percentage should be invested in your vested shares? Well, you'll notice in the slide, where is that slide? 10% is what I said. If company stock is more than 10% of your long-term portfolio, considering now. Honestly, that's kind of pulled out of the air. I don't know what the right amount is. I believe, and this depends on your situation, of course. So, okay, so I have a client who most of their wealth is in their investment portfolio. And they have 40% in company stock. And that portfolio is not enough to get them everything they want in life. They still need future income, both from salary and from gains from the portfolio. So by keeping that stock, they're risking actually making their lifestyle that much worse with a 40% exposure should the company fall on hard times versus the rest of the market. That's the downside risk. Of course, the upside risk is it could do much better. But for most people, they can adjust to a lifestyle that's slightly below where they want to go, as opposed to risking a lifestyle that's far below where they want to go. So that's the conversation we have around that, and that's the context we have. I don't really like using a hard number. I understand the value of it. It makes it easy to think about, but I don't like using that. I have another client who has a lot of money. He's got, what is that? 3, 6, 8 figures of money. More money he's ever going to spend. And 30% of that is in company stock. And if all his company stock went to zero, wouldn't affect his life one bit. So am I pounding the table saying that guy should sell his company stock? No, we're having conversations more along the lines of where do you want to do? Where do you want to go? What do you want to use these funds for? Do you want your kids to inherit these funds? Do you want to give it to charity? How do we structure that? And once we figure that out, once we figure out the use of funds, then we can have a more rational discussion around the risk of the funds. We can't really have that until we know what we're using them for. So hopefully that gives you a little insight into planning and how it works. I was thinking of regular quarterly lockups when you have a day or two each vest to decide to sell. Oh, okay, so that was back to the quarterly. So when you have a day or two to sell, yeah, and it may not be the best days of the quarter, but the fact is it's your reality. It's the only days. Create a program to sell. And there is a program to sell within lockup where you'll have to talk to your employer about this, but you have to design, I think you design a target stock price or a time period, regularly sell this amount of shares, and you can set that, you typically set that up. Most companies allow that. Remember these lockups, we're talking about like around quarter end for insiders, that all of those rules are not invented, but they're created by the employer. So the employer can make changes and exceptions to that. So if you're serious about wanting to get on a program to sell so much stock per month or per week, talk to your HR department, see if they'll let you structure something like that. Okay, here we go. Another one. My spouse has RSUs overseas. Are there any differences in how to handle besides taxes? Okay, RSUs overseas. So I'm not sure I understand that. If the spouse is here in the US, and let's say they're in Roche, the drug company, and they're in the Swiss. Oh, it is Roche. That's funny. Well, not too surprised. A lot of Genentech Roche people around here. So that is still just like U.S. stock. I've got clients with that stock as well. So it's operated the same way, taxed the same way. It's denominated in Swiss francs, as you know, but the tax effect structure and all is exactly the same. Okay, do you recommend an RSU strategy similar to dollar cost averaging for investing to sell a scheduled amount of RSU stock over time in order to reduce risk? So I'm gonna I'm guessing what you mean is within a tax year. So what I was talking about was how much do you want to sell each tax year? And now I think what we're talking about is saying, okay, we're going to sell $100,000 of stock this year. Should we sell it all today, or should we sell it, each month for the rest of the year? Right? I'm pretty sure that's what you're asking. If it's not, please correct me in the chat. Yes. Okay. If it makes you feel better, and if it makes you follow through with the plan, go for it. The reality is, I'm not sure it makes much of a difference, and here's why. Let's say your stock is $100 today, and here we are in May. What we're talking about is the difference in the stock price between today and December 31st. I think we should be able to agree that we have no clue what the stock is going to do in that period. It'll probably be around $100 where it is today, but we don't know. Today, we know it's worth $100. We know we're going to sell it in the next 7 months. We've already planned that. It's a fact. Why would we take the extra risk to hold on to it that's going to go down? Yes, it could go up for sure, but the bird in the hand, reinvest. If you reinvest in a long-term portfolio and your stock goes up because the market goes up, remember, you're going to get some of that gain, at least some of that gain, maybe even more, by reinvesting in the other diversified portfolio that has less risk. I think it's super important to get your risk right and then let the return come to you. And I guess that's probably the bias that I'm working with here. So there we go. All right, more questions. I really appreciate everybody staying on this long. Thank you so much. Happy to do these conversations. Really enjoyed them. Okay. Is there anything special you can do with your finances, stock or otherwise, that you donate in order for them to be maximally impactful? Are there any tricks to make sure the charity organization gets the highest amount possible? Yes, there's tons of them. There's a lot of them. Depends on the amount you're donating and whether this is an annual donation program that you plan to go on year after year. Happy to answer any, if you want to provide some clarifying information, that's great. But let me give you just one tip that's really great right now, especially in California. I don't know that you're in California, but if you're subject to the SALT limit, those deductions, you remember the $10,000 cap deduction that we get to take for state and local taxes, that really limits your deductions on your taxes. What you have in exchange for that is a higher standard deduction, which is now $24,000 and some change for a married couple. If your deduction falls below the standard, and so you're always taking the standard, even though you're giving money to charity, you're not getting any benefit from giving the money to charity. So what you can do instead is you can lump your charitable donations. Give 3 years worth of donations this year. Don't give any the next 2 years. You'll get a higher total deduction this year, and then you'll still take the standard the next 2 years. So that's called lumping your charitable donations. Another way to do that is to create a donor advised fund. If you're giving a significant amount of money, that's fairly easy to do. And that's another way where you can put a large amount of money into the donor advised fund in a year, let's say, where you have a lot of taxable income, let's say where your company goes IPO. You put a bunch of money in the donor advised fund, you get the tax deduction today. It sits in the donor advised fund. You control where it goes. It hasn't been given to any in charity yet. You designate where it goes and when it goes and how it's invested in the meantime. So it continues to grow and you can dole it out over the next several years, even though you got the whole tax deduction in that same year you had the high income. That's another great way to do it. And there's a lot more. Believe me, depends on your specific situation, what you want to get done. Okay. When RSUs get taxed on vesting day, is it reported on a 1099 and that is used to calculate the pay to tax? Does that question make sense? Yeah, it totally makes sense. It's not recorded on 1099. So when you get RSUs, you are a W-2 employee. It goes right on your pay stub. So you can see it on your pay stub. Right after the vesting date, you'll see it, and you might, it looks different on every pay stub, but you will see compensation, gross compensation in the form of the vesting, and you'll see the money that was taken out and sent to the IRS there as well. So just look at your pay stub to see that. Doesn't give you all the detail, but you'll be able to see kind of the effect of that. All right, let's see. Any more questions? We still have a lot of people online, so I really appreciate that. I'm glad this is helpful. I'm going to give it a couple more seconds. And if there's no more questions, I'll go back and answer the 2 questions about that are a little bit more sales oriented. So I'm going to take a sip of water, just a little break. Wearing the earbuds, so I apologize if you heard me swallow there. Probably did. At least you haven't heard my dog moan yet. She's laying over here. Okay. I don't think there's any more questions. So let me go back and answer the other questions. Got to find them. Where is it? You sell the stock after day 1? Nope, we did that. Do you give tax advice or do you, nope, we did that. What is your fee structure for ongoing financial advice? Well, great question. Let me just make sure you're still here. Well, yeah, you're here. So what is my fee structure? Here's the structure. I focus on financial planning first and only investments in support of financial planning. So when I work with clients, it's financial planning first. And then later on, when we get to the investments discussion and we cover investments, we create an investment philosophy and an investment strategy. My clients can go away and implement that themselves and not pay any additional fee, or they can hire me to implement it for them, and there's an additional fee for that. So the financial planning relationship is first, and that's a flat fee structure. It depends on the complexity of your situation, so I can't give you a number. And then the investment management, if you want me to manage the investments, I charge a percentage fee of the investments managed, or again, you can manage them yourself. So that's how I do it. My hope there is that I'm putting myself on the same side of the table as you. I don't earn commissions or anything like that. So my advice is fee agnostic in that sense. I get paid the same no matter what I tell you what you should do. Oh, let me put this link in here again for the free meeting. Just link. There we go. There's the link again. I got one more question about working with me. Let me find that. How much time do you spend with clients per year? So that financial planning arrangement is unlimited time, unlimited meetings. And in the first year, we'll typically have 6 to 8 meetings, maybe more, not usually less. And we'll go through what I call the best life breakthrough process, which is what I showed you up here. So we'll go through all of this stuff. We'll get your whole financial plan built out, get everything in shape. And then in year 2 going forward, I'm going back through your plan and updating it on a quarterly basis. You can see we're right now in the 2nd quarter, so I'm working on investment structure updates for current clients. I do a report, PowerPoint form, 10, 12, 15 pages, send it to my clients. If they want to have a meeting about it, we have a meeting. If they don't, that's fine too. But that's coming at my clients every quarter with any recommendations or anything that I see we need to discuss. So unlimited time, I guess, is the short answer to your question. Thank you for those questions. That's it. Thanks so much for joining me. I really appreciate the questions.